Hey everyone, in this educational video, we're going to cover the number one question I get every day, every week, every hour from clients, and that's, should I set up an entity and which entity is best for me? We're going to cover all those questions as well as some questions you're not currently asking. Let's get right to it. Hello and welcome to our entity overview and considerations educational video. So first of all, we again need to disclaim that a lot of this is provided to you as general overview information. We're really trying to give you a context on which to base our one-on-one time with and our call time with. So make sure that you're mindful that there are exceptions to all these rules and you may be that exception. I wanted to cover setting up entities because we get a lot of clients asking, how should I set up an entity? Which entity is best for me? Well, the number one question you should be asking is, should I even set up an entity? The question really is, should I even bother? And I'm going to tackle this by taking two approaches. One is I want to do things right versus I want to do things fast. I'm asking, are you looking to protect yourself from day one, or are you looking to really get your business operationally sound and build the airplane on the way down, so to speak, in which case you're probably more revenue focused. The distinction is really how you think about risk versus reward, and we'll get into that. But first, let's talk about this from a 30,000 foot view. There's really two overarching points when it comes to entities, and I will say number one is liability, number two is economics. But first, up front, I need to disclose that I'm not a lawyer, so this isn't legal advice. My observations are from the field of battle, if you will. So imagine I'm reporting trends and principles of warfare as a soldier versus a military academic. You'll need the expert on your final war plan, but here's an initial report from the scene. So I'd use that silly analogy to really communicate that this is really what we see day to day and not legal advice. So generally, a legal entity helps protect your personal assets from your business operations and the associated risk. The question to ask yourself is, what are those risks? Who am I doing business with, and will they ever sue me? The question asked specifically in the sharing economy is, does the current platform I use already provide some kinds of protection? And we'll touch on that on an individual basis, and I'll try and get general about it now. So that was the liability component. The other big component that I always want to talk about in entity overview is economics. And I say that because there's more to just economics than tax. Tax is one component, a very large one, but I want to encourage everyone to move away from a tax singularity view. In fact, my own corporation exists for multiple economic reasons, including, yes, the tax return, but also to build credit. So now in the year of business that I'm in, I can get a car lease on my business. And there's some value to having that debt on the corporation instead of on me personally, right? So there's some benefit to having things on the corporate side versus having it impact your credit utilization. So I want to be conscious of that. Anytime we're getting into a one-on-one and you bring up a question, ask yourself, is this a liability consideration or is it an economic question? Is it about finances? Is it about tax? So next on our agenda is doing a very high overview of the entity types. And as you can see here, we have the entity types listed in the top, and we have federal income tax considerations as well as state tax considerations. So we're going to get a little tax focused as we now move into this. But of course, as I shared before, you want to also get clear on the liability side as well as the non-tax economic consequences. But now that we've covered that, let's dive right into it. What you'll see here is a table of C Corps, LLC, partnerships, and S corporation types. Big thing to note is that the three entities on the right are what's considered pass-through entities, where a C Corp is considered an individual entity that stands on its own. And what that really means in simple terms is that pass-through entities will be taxed at your personal rate. So from an economics perspective, it's almost as if all of that activity is flowing through to your personal return as if it's not even there, right? So in those plays, what we're really talking about is the entity exists as a separate legal entity, but the economics flow through to you personally. And that's different from a C Corp in the sense that a C Corp will be taxed on its own P&L before anything's passed on to the owners. So imagine that you have a company that makes $100. A C corporation will first be taxed at the corporate rate of currently 21%, thanks to the Tax Reform Act. And Donald Trump. And that would be $21 off that. So now you have $79 left. Now, if you want to pay yourself that $79, it's going to get taxed again. So that's the concept of double tax, right? So there's a corporate tax, and then you're going to get a dividend tax if that's paid as a dividend. So long-term, rate on that ordinary rate, let's just say at the lowest, it's going to be 30%. So you've got 30% on 79 now. That's going to come out to something like another $20, right? So all in, we're not modeling this out just yet, but you're in at $40, which comes out to a 40% tax. So I want you to understand that because that's different from how it works with a pass-through entity where you might make $100 and what's the entity level tax on that? There isn't one, right? It's pass-through. So what's going to happen is that full $100 is going to get reflected on your personal return, and that's just going to be subject to your personal ordinary rates, right? So again, with the corporate, we had 21%. On the personal side, it's going to be whatever your ordinary tax rate is. So if we tackle these individually, what's the difference now between the LLC partnership and S corporation? Generally, the big difference is going to be that a partnership is going to be split between its members. So again, you have that $100 of income. There's two partners, assuming 50-50 ownership. You're going to get 50 on yours, and your partner's going to get 50 on their personal return. So partnerships are usually any entity with two or more members that is not a corporation. The other big question I get is always, should I set up an S corporation? Why do we hear S corporations so much in the tax business? Well, there is some truth to them paying less in taxes. And the reason why is that all pass-through entities are going to be subject to self-employment tax, where an S corporation is only going to be subject to a portion of self-employment tax. And there's a way to get there, and we'll cover that when we dive right into S corporations. But for the most part, that's going to hold true. We also have in the lower column the state tax considerations, which are really important. So for anyone listening to this in California, every one of these entities is going to be subject to an $800 franchise tax fee, no matter what. Whether you have zeros, whether you earned a single dollar of revenue, California doesn't care. You're going to be on the hook for $800 every year, no matter what, as a minimum. Something to note. Nevada, we've included as well. We often get that as a question, and you can just see that the costs are a little different. So Nevada charges $400 for filing and then $200 annually, so it's cheaper on an annual basis. But again, where you set up a LLC or partnership or corporation is going to be based on a multitude of factors. So don't just say, okay, Nevada's cheaper, I'm going to go there. So those are the full scope of entities that we consider when setting up. And on the next slide, we consider big question number 1. Should I even bother? And the reason we have this diagram up here is we're basically showing you how it works without an entity versus what the transaction flow is with an entity in between, right? So on the right side, you have me as a sole prop working with clients. And you can see that there's no complexity there. It's just me and my clients. And if anything should happen, right, back to the liability question, where my client says, hey, wait a minute, I don't think this was fair. I don't think I got my money's worth. I think you damaged something, my car, myself. They're going to sue you, right? They're going to sue the person they're doing business with. That's something to consider when you look on the other side, where you have me, the individual, you have LLC, call it Company A, doing business with clients. Because if anything happens, the client needs to go back to the LLC and say, wait a minute, whatever the complaint is, refund, damage, what have you, you fill in the blanks. And they're going to have to sue the LLC. Well, if the LLC doesn't have anything in there, then the LLC can go kaput. It can go bankrupt. And that doesn't impact you. It doesn't impact your personal assets and liabilities. And again, I just need to disclaim that this is an ideal scenario. There have been cases where in certain lawsuits, if there's ever fraud, you can do what's called piercing the corporate veil, which means that instead of going to the LLC, they can still get to you. So there are exceptions to this, but just note that this is the general idea behind doing that. And I asked some questions on the liability slide, which is, who am I working with? What guarantees do I have from the platform that the people I'm working with can't sue me? And that's something to look at, especially if you're on something like Upwork where you're contracting through a platform, or on Airbnb, you have a $1 million guarantee. The question to ask is, how comfortable am I with those guarantees that I don't need an entity, right? So when do they make sense? I think it makes sense anytime time you are concerned about your personal assets. So if you look at the very, very wealthy, they don't have one LLC, they have 18. If you look at someone that has multiple properties, they've usually put most of their properties in their own LLC, because not only are they worried about LLC laying claim to me, right? Clients laying claim to my assets, they're worried about clients working with company A laying claim on company B or C or what have you, right? So the question to ask yourself is, how risk averse am I and how concerned am I about my personal assets getting involved with my business risk, right? The second thing to consider is, how easy are they to set up or wind down or close down? And that gets into how long you see yourself doing this. So if you think that you're testing this out for a year, anything less than 2 years, probably doesn't make sense to pay the setup fee this year. And guess what? When you close it down, do you think it's free? It's not. You're going to need to pay again to unwind the company. And if you're in a state like California, you're going to have to pay that $800 again. So it does not make sense to set up an LLC unless you're very, very risk averse from an administrative standpoint, if we're talking about anything less than a 24-month run rate. So be sure to consider those as you're thinking about it, and look specifically to your state. It's much easier to close a company in Delaware than it is anywhere else. That's not exactly true anywhere else. So the last question is there a tax benefit? So this gets back to the economic component. Is there something that I can do with an entity to lower what I pay in taxes? And that is where you need to consider how you're doing financially. So if you have a very low tax rate, setting up an LLC isn't going to do much for you. If someone usually asks me, hey, is there any benefits to just setting up an LLC? Well, is it an LLC taxed as an S Corp? Are there partners involved? If it's just a single member LLC, chances are there is not a tax impact. And we'll cover that here. And this is question number 2. How does this affect my taxes? One point I want to drive home is how many partners you have will impact how you file. And what I mean by that is that if you're splitting $100 between 2 partners, like I said earlier, you're going to only reflect a portion of that P&L. There isn't a process to say this expense is mine, that expense is yours. Process is that you report on a consolidated basis, right? So you have one entity that shows that $100, and then you'll get what's called a K1 from each. So each individual partner is going to split a piece of that pie. That doesn't apply if you don't have any partners. If you have a single member LLC, most of the time, it's just going to flow through on a Schedule C. It's not going to have a separate P&L. It's not going to have a separate filing. It's going to be a part of your personal. In these cases, the tax impact is not significant, right? The point of an entity for a lot of these pass-throughs are going to be either, hey, look, I've got a partner, so we've got to report it a certain way, or I'm concerned about liability, therefore I'm going to set up an LLC. So in these cases, the tax benefit, I'm going to call it marginal. Now, I know some people might disagree. They might say, hey, with an LLC, I can take more business deductions. That's generally true, but if you came to me with the same P&L and you said, hey, I've got all these deductions, I'd probably still take it even if you didn't have an LLC. So I'm not a big proponent of setting up an LLC if you have no liability considerations, you have no desire on the economic side of creating business credit, and you're just looking to get a tax benefit and you're not setting up an S Corp, right? So I want to say that in some simple cases, it might not make sense, right? If there's not the liability issues that we've talking about. The next thing that I want to jump into is big question number 3. We just talked about that there could be very little tax benefit. So the question number 3 is, what's in it for me on this next slide? And one thing that I always say is look at the benefits of business credit. There are things there that a lot of people overlook. Like I was saying before, it makes sense to put debt on the business such that you don't incur it on your personal side. And for those trying to refi their mortgage or trying to take out a loan for other reasons, the less debt you have on your personal side, the better. If you can shift that onto the business, do it. You'll also get a decent rate. Now, if you have a brand new business, you'll still need to sign a personal guarantee. However, credit reporting agencies will not report on it, right? So it'll still hit your credit in the sense that you need to personally sign off on it. But the other benefit is, again, going back to the timeline, if you're going to do this for more than 2 years, banks will not check your personal credit history. Banks will say, you know what, you've got 2 tax returns, you look like you're doing well. Again, these are when you have a separate partnership or a separate corporation. They're going to say, you know what, this looks really good. We're just going to go ahead and put the liability on the company. And there you have it. You've got a line of credit at a favorable rate that doesn't hit your credit report. And then the other thing that we've seen, and what the data suggests when you look at how the IRS audits, every year the IRS puts out a report on how many people they audited and what the total size of filers were and the corresponding percentage of audits. And generally, your audit rates are really low, right? Less than 1%. Well, they also show how many Schedule C filers they audit versus how many partnerships versus how many S corporations versus how many C corporations. And the one truth that you can see when you look at the data is that Schedule C filers are some of the most audited groups that the IRS looks at. And you might think that that might be for a number of reasons. One, if you don't have an entity, you're not that sophisticated, or you might be making things up, in which case, why would you create an LLC, right? If you're making a fake business, why would you go through the process of setting this up? And the other reason is, if you don't have an entity, maybe you're not sophisticated, maybe you don't even have bookkeeping. And these are reasons that basically drive these numbers to get the IRS to put a little more attention on non-entity holders. So going down that logic, right? If you look at the rate of single member LLCs without an entity and those with one, the gap is about 12x, right? So if you take that statistic and don't take this out of context, but if you just look at the numbers, you would be able to reasonably say that single member LLC filers have a 12-time chance of audit risk versus someone with an entity, right? So there is something to thinking that an LLC will give you a little more legitimacy. If you can get your banks and your accounting records sorted out under the LLC, it's going to make you very sound anytime a bank or the IRS looks at your books. So those are some more ideas that I think drive decisions to set up an entity, right? It's not just your basic LLC liability play. Sometimes it is just getting a little more organized. So I want to do a quick overview now that we've touched on the benefits, the pros and cons on the specific entity types. So here we are on the LLC overview. Big take-home point, if you forget everything else, this is not a federally recognized tax entity. So from a federal perspective, they don't recognize the LLC, right? If it's single member, then they're going to say, okay, you know what, Joe, you set up the entity, therefore it ends up on Joe's tax return. We have the EIN, but really this is Joe. LLCs are state set up. So the states do recognize it and you get all that benefits from a liability perspective. But again, federally, they're just going to look at, okay, what's the tax classification? So they're really flexible. That's kind of the pro to it is an LLC with more than one partner. They're going to say, okay, that's a partnership from our perspective. And then an LLC can elect to be treated as something else. It can be treated as an S corporation or a C corporation. So oftentimes if you're asking, hey, I want to set up an S corporation, why would I set up an LLC? Just remember that an LLC can operate as an S corporation. They're very flexible. The next one I want to jump into, because this is, again, the top question we get is S corporations. So S corporation is just an overview. It's established by Congress as a small corporation, that's what the S stands for, to provide relief on taxes. It exists for IRS purposes. It is not a legal status. So some people say, hey, can you set up an S corporation? And then I say, well, do you need an LLC or a C corporation? And they get confused. They say, no, I said S corporation. Well, S corporation can either be a corporation tax as an S corporation or an LLC tax as a corporation. And that election is made on Form 2553. You can get that online and do it yourself if that's what you'd like to do. The point being that it is an election that you make. So what's the benefit and what's the cost, right? So it's also a pass-through entity. However, the profits from an S corporation are not subject to self-employment tax. So if you go back to your Tax 101, you're going to see that 15% on top of your federal income tax rate is going to drive your self-employment tax, which is pretty significant. So we're really talking about a potential 15% drop in your tax liability as an S corporation. But is it all benefits? Well, no. There's requirements that come with the S corporation, and first, restrictions. Maximum investors of 100. So if you're looking on getting funding down the road, this is not the entity for you. unless you want to keep your number of investors to less than 100. But what I'm talking about is institutional funding. A VC or private equity looking to invest in you or buy you will be shy about S corporation status. One class of stock, again, this mostly applies for those looking to raise money or issue shares. And then all shareholders must be US citizens or official residents. The last point is the most important, which is that you must pay your owner salaries as payroll, which requires payment of employer and employee taxes. So I was saying before, there's no self-employment tax. Well, hey, the catch is you have to salary yourself some component of earnings, which means if you are in a loss as a company or you have enough deductions where you don't have any income, it doesn't make sense to salary yourself on top of that, because then you'd be in a much bigger loss, right? You'd have to put money into the company to take money out of the company and then get taxed along the way. So loss companies don't make sense for S corporations, right? This is where the economics kick in. So something to be mindful of. Caveats of if an S corporation is right. That's our next slide. If the salary is too low, the IRS may disallow the drop on the self-employment income. So basically what that means is if you don't pay yourself a reasonable salary, the IRS may come in and say, you know what, we're not giving you the 15.3% drop we were talking about. We're going to treat you just if you were a pass-through LLC, meaning you should be incentivized to pay yourself something reasonable. And the way to get comfortable is to get a sense of what reasonable salaries are. So you can do a comp analysis where you say, you know, I'm managing properties. I'm going to go look at the average property management salary in the country. It happens to be pretty low, right? If you kind of factor all regions in. Therefore, I'm going to pay myself that $30,000 average, and that's going to be my minimum salary. So just note, if you have profit that is less than $30,000, it probably doesn't make a whole lot of sense to salary yourself everything you make, because then you've got the same treatment as an LLC, right? So to really have a benefit, you've got to be able to show that you make above the reasonable salary. So in this next slide, you can see we've done an analysis on the S corporation versus the LLC so that we can calculate out what the tax benefits are. And you can look at the details individually, but just the high level point is that they have the same business taxable income. In the LLC case, all of that income is subject to self-employment tax plus federal income tax, right? So in this case, on $100,000 of income, something less than that, you are going to get a total tax of about $27,000. Whereas in the S corporation column, you can see a few things going on, right? There's some wages, some deductible expenses, taxable income goes down because you've salaried yourself. There's self-employment just on the salary. So you can see the big difference on self-employment tax with the LLC. The self-employment tax is something like $13,000, where the self-employment tax on the S corporation is only $5,000. So net, when you compare it, you end up with a total tax of about $20,000 on the S corporation, which is essentially savings of $7,000 on these numbers. So the benefit can be significant, but again, the point is that the business taxable income needs to be high enough to realize that. Otherwise, the difference in the effective tax rates are going to be very small, in which case you've now set up an S corporation, you filed this form 2553, which we talked about earlier, you've issued payroll, which costs, there's administrative costs to that, and now there's no benefit. So you want to be very clear that there is projected benefit before moving into that. So that's our high level overview. As you're starting to think about this, really ask yourself, which entity considerations meet my risk versus reward profile? How big is my concern about being sued? How comfortable am I with where I am about my projections? Are my projections big enough where an S corporation could make sense? These are the questions to start asking yourself, and hopefully they serve as a foundation for us to speak on the calls that we'll have together. The last slide that I wanted to go over was the C corporation. So I'm going to touch on this very briefly because it's very often the case that we do not set up a C corporation anytime we have, a solo team or a husband-wife team or a partnership group of something like 4 or 5 partners. But it is the case that sometimes we will set up a C corporation, and the general saying goes that the corporate veil is much stronger with the C corporation because there's more administrative requirements. So anyone looking for easy, C corporation is not easier. There's more to it. But plus to that side is that the benefit of liability, again, speaking generally, is greater. And corporate law is well established on how C corporations operate. So if you can check all those boxes, you have a little more security. And then the last kind of important point is that in the event of a bankruptcy, there is no obligation on the owners. That's called indemnification. And usually if you're in a state with established corporate law, the indemnification clauses are going to be a saver in more situations than with an LLC partnership or otherwise. The note on the double tax we made earlier, you do end up paying a little more on that. So with that, I'm going to wrap up here. That was our overview of entity considerations. You really should have a strong list of questions that you have either for yourself or for our team at the end of this. And again, if you have any questions, please reach out to us. You should have a link to do so, and feel free to collect your questions for our next call. We'll look forward to having that. Thank you.